Hey, everybody. Welcome to the Sense of Things. It's Jeff and Ron here once again, and we are kicking off another week. A lot of craziness that's happened during that time period. Of course, we've had the actions happening in Israel. We've got some economic stuff we're going to talk about today. We've got a little bit, Ron's got some stuff on the markets that we'll talk about, and we've got an interesting pop culture thing to talk about. Ron, how you doing, bud?
Morning, Jeff. Good. Other than international news, you're right. It's a slow week, despite the fact that had a couple of economic the PCE came out and CPI is coming out today, tomorrow.
Yeah, I've got a slide on that we'll cover PPI and CPIs.
Yeah, so we'll talk about that. But other than that, not much is going on. I think a lot of people, other than what's going on in the Middle East, I think a lot of people are waiting on corporate earnings, which so far have not been too bad, even though some have been retrenching some employees, but nothing on a mass scale.
Yeah. And I think, as we've discussed with previous quarters, it seems like they're now ahead of time guiding down pretty significantly coming into these so that the earnings reports actually look like they're in line or surprises at this point.
I hear you. What do you want to start? You want to start with your pop culture?
Why don't we start with the pop culture piece? And this is you being a Philadelphia Phillies,
absolutely,
or a Philadelphia native.
Red October.
Yep. Here's what could have been more Red October. A Philadelphia Phillies fan this week tried to get into the game with what he was calling a service animal, which was actually an alligator. So it is an emotional support alligator.
Yeah. So let me ask you, what's wrong with this?
Yeah. I remember my Dallas Cowboys going to Phillies games and the fans balling up batteries in snowballs and throwing them at the players. But this is a whole new one for me.
We only did that to Jimmy Johnson and the Cowboys about 35 years ago. That was it. Which is another reason why they stopped selling beer after halftime.
Yeah. The thing I'm trying to figure out here is it's Philly. Maybe if this was Miami, I could figure this out. I could see an emotional support alligator, but I'm just guessing. I just don't know where he got the alligator from.
I think this guy needed attention. He probably didn't even have a ticket for the game.
Yeah. And the good thing is nobody actually put him on any news channels that I could see. It was just this one little post.
It had to be a joke. That's all it could be. But it's funny.
I love it. Interests me. So a couple things on the economic front yesterday. So once again, really quiet week. I think probably the only thing I saw other than these couple things I'm going to cover, mortgage applications were up a little bit, which we've had the kind of flight to safety where people have been buying U.S. government bonds, and that's pulled the 30-year or the 10-year rates down and got people going. But this week, I think the biggest shocker, I think, for a lot of people was the PPI, which came in, consensus was 0.3 and it came in at 0.5. So it was way at the top of the consensus range. So
but the year over year was out of range too.
Yeah, significantly out of range for year over year. And it was 2.7% ex food and energy, which energy prices have been way the heck up. And year over year, with energy and trade services in there, or ex food, energy, and trade services, up 2.8%. Once again, we're seeing these kind of numbers where producer price indexes are way up. And if you looked at CPI this morning, CPI came in above consensus and way the heck at the top of the range there again. It was within range of with the year over year, but the month over month was way at the top of the range. That still gives, I think, the Fed the ability to say, hey, this is not under control, and we're going to continue to have to be vigilant and tighten.
There's no doubt this gives them essentially the green light for another quarter-point rate hike, whether it's November or December. But there's no doubt this basically gives them the green light to do that. I can't imagine that another number is going to come out next month and it's going to be significantly different. All this is still riding their trend of higher for longer, but I think one more rate hike and let it lie until Q1, see if there's any drastic effects and go from there. I don't see anything different at this point.
Yeah, I think it's going to be interesting to see how the situation in the Middle East, if it gets out of control, if more people get involved. I think it's a foregone conclusion that Israel is going to go in and just completely pound on Gaza and
they're going to eliminate them.
Yeah, it does. You have to. These are animals, and you're going to have to do that.
See,
But how does that then affect all the relationships?
The problem with insurgents and that is they're not wearing uniforms, right? They're wearing street clothes. So how do you decipher who's somebody good and who's somebody bad? I have no idea. But look, Hamas doesn't have any manufacturing resources, so they got the missiles and the ordnance from somewhere.
Yeah,
and there's only one of 3, maybe 4 places they could have gotten them.
Yeah,
let's say it's not China. It's either Iran, Russia, or North Korea.
Yeah,
that's it.
Yep.
And Iran has been known to finance them and Hezbollah and whoever. So if they do link it back to Iran, sanctions aren't going to work this time. Actually, they don't work ever, but they're certainly not going to work with them. So what's the ripple effect here?
Yeah, and I think what's the ripple effect amongst the Arab community and everything else? They've been working for so many years on the Abraham Accords and starting to pull some coalitions together. And how does this break that up and throw it off track when we get back to status quo that's been for the last 50 years in the region of that just destabilized environment and the us against them. So I think that's going to be intriguing to see how that affects. We've seen the market up, and I know you're going to do a little piece on the market and what's been going on with the S&P. It's been shockingly up this week, and I would have never expected that.
I agree. So let me get into a few slides, because my last slide is talking about the S&P.
Yeah.
So this just came out this morning. We had an 8.7% increase in Social Security this calendar year. They now announced it 3.2 for next year, which is still, above the norm, because in the past it was always either around 2% or 0.
Yeah.
So to get an 8.7% one year and 3.2 the next year, that's a pretty good bump. I mean, if you're on a fixed income, and unfortunately, if you're only relying on Social Security, you need every basis point jump for yourself.
Absolutely.
And on the bottom there, I thought this was just interesting, because what does that really mean? The average estimated increase is about $59 a month. So maybe a gallon of gas for a mid-sized car. I don't know, but
no kidding.
Yeah, it was a little $5.29. I filled my car up yesterday. It was brutal. Yeah. Arizona just surpassed California as having the highest average gas prices about a week or two ago. I don't know where it stands now, but whatever it is, it ain't good. I know in Texas it's probably the cheapest.
I filled my car up yesterday for $2.89. Sorry.
$2.89. Are you sure you don't have a decimal point problem there?
No, it's $2.89. Yeah, it was, and I did it at a place where I don't get a discount. We have a grocery store that we shop at that gives us credit every time we buy for gas. And I filled my truck up a couple weeks ago, and it was $1 off. So I think I filled up for $1.89.
That's funny. All right, so that's Social Security. Let's move on. So I know we have talked a little bit, or at least I have, to ad nauseum about our debt. No politician is talking about how the hell do we cut this thing in half. Here you go, folks. Forget about all the social BS issues for the election. Here's the problem. Here's the biggest problem of them all. This is what's causing inflation. This is what's causing a lot of problems. And this is what's also going to create a higher poverty. We're spending more on just paying interest, our debt, than what we're paying for national defense.
Yeah. And that I'd seen something about 2 months ago that was saying this was going to be like 2035 when this happened. And all of a sudden now it's got shot forward to here.
Here, look at the bottom sentence. $2 billion a day.
Jeez.
In just interest.
Yeah. We're having a fund now helping out Israel, which we should, but we're helping Israel. We've basically got a blank check written for Ukraine, and we're just plowing money out left and right. Not to mention what we're doing internally, but starts to get scary here.
It does. And look, I don't have the answer. And even if I was a politician, I had the answer, nobody would listen, right? No. They're too focused on trying to kill and destroy each other, that this is what's going to probably end up killing and destroying the United States. This is what's going to end up killing our reserve dollar status if we can't find a way to halt and reduce.
Mm-hmm.
Not just halt, but we need
Yeah.
to reduce it. And look, raising taxes is one way, cutting spending is another. But when you got the top costs being Social Security, military, and other entitlements, where do you cut? Where do you cut? And I don't have the answer, but I'm just putting this out there to raise attention more, because some politician, look, they're not going to make it their number one factor because they've done all their polls and studies and surveys, and this is not top of mind to the average person.
Mm-hmm.
You know, the average person is trying to pay their bills.
Yeah.
If you think about it, they're trying to do what the United States is trying to do. They're just trying to get to the next month.
Yeah.
It's sad. It's
basically what we've done as a country is basically what a lot of people have done, which is they've charged up their credit cards, and now the credit cards are up in the 26% range.
The credit cards, there's a credit limit.
Yeah.
Hence our debt limit, which is going to come up again next month. And that you thought it was a bloodbath last time?
Yeah. Oh, it's just like I said, and you've got people that are just not going to budge, and nor should they. And somebody's got to stop this at some point in time. And I think what we have to do as investment advisors is we always have to think ahead of what's happening. And sometimes it's hard to do when you're looking at, okay, the market just keeps going up, up and up. And how do we plan ahead for that future, that eventual future that, we know is it's going to come to roost at some point here.
I agree. So this is just something else that was interesting. I'll leave this up for a minute. We'll look at it. We'll talk about it. But this is talking about who owns our debt. Okay. And, some of the big countries have sold it off in the last couple of months, which is what has driven yields quite a bit higher.
Yeah.
But I just think it's very interesting that foreign governments and private investors are one of the biggest holders of public debt, owning 8 trillion of the 33. Right, which is 25%. Mm-hmm. I don't know how this is sustainable. This is frustrating.
Yeah.
So
you just don't. Yeah. Okay. So that's 8 trillion out of 33. Who's going to be the one that rescues it when it just keeps ballooning up? If these foreign countries are like, it's not so good.
They can't keep printing money. That's the solution to everything. Yeah. And it's not going to be. I don't know how reserve currency actually gets taken away from you. But maybe it's when you can't pay this debt anymore. I don't know. I don't know. Yeah. All right. So my last slide here, and I cleaned this up a little bit. So for those people out there that are not technical or don't understand technicals, let's just go by this. This is as of an hour ago.
Yep.
So the blue line is the 50-day moving average. This is where traders will trade along, right? Whether it hits up against or as resistance, or it hits it on the top side for support. The 200-day is really what you want to be more concerned about, because this is institutional. This is where the big companies, the big boys, the big girls out there are looking to say, hey, when it gets down to a certain level, it's stronger support. When we had that pretty nasty pullback in the last month in September, all right, we went down to the 200-day, we pulled down above. This was the job report on Friday, which I think shocked a lot of people because it wasn't great. So you would think that, wait a minute, that should be one of the recession signals saying if we're going to have higher unemployment, right? Maybe they're looking at higher unemployment means, okay, maybe we're at the end of the rate hike cycle. Now they're going to start to lower rates. I don't know the mentality. All I know is they use the 200-day as support. And look what happened in the last 3 days, bumped up against the 50-day. So my little thesis here is that I think these bands, the 50 to 200, are going to narrow. The stock market will trade within that band. And then one of two things is going to happen in late November if we get the shutdown averted. One of two things is going to happen. It's going to pop like a coiled spring to 52.20 and end the year, or we're going to pull down to the 4,100, 4,200 level. The 4,100 level I think is more realistic. We'll have to see. But you know what, folks? Technicals don't lie, right? Because the next resistance line up here is this trend line here, which is around the 4,400, 4,450 level. We'll have to see. But I think that the technicals tell a bigger story right now than a lot of the economics. because we all know that 2/3 to 3/4 of the trading that's done is done by computers, right? All those algorithms out there, and they're trading on technical levels. They're not, these algorithms aren't trading on fundamentals. They're not trading on economic factors. They're trading on technical levels. What are your thoughts on this? I don't know how often you follow technicals.
I am a big technical guy. I typically do it more off of the individual securities that we'll hold. But yeah, I agree with you. I think it's intriguing to me to see how fast this trend snapped back. It was pretty much a pretty straight downward trend there for a while. And then all of a sudden it just snapped back like crazy, which typically means, from my perspective, you see a little bit of profit taking happening. But do we bounce off that 50-day and bounce back down to the 200 and just keep this wave back and forth? And I personally think that's where we're going to be for the next several months. I don't know if we're going to shoot to the high side. Something dramatic's going to have to happen there. But personally, I think what is happening is everybody is so hyper focused on what the Fed says. And if the Fed says, okay, we're done for a while, at least there's some certainty there. And then it's going to be, okay, what 6 months down the road, do you feel like they're going to start lowering interest rates? And then the market's going to basically have a big guess at that point.
The Fed futures market is indicating, starting, I think it's July next year, it's not over 50%, but I think June, July, and August next year is about a 40 to 45% or a lower percentage. That's when the first rate cut may be. Remember, we were talking about this 3 months ago. People were talking December, which was just ludicrous. But now it's pushed out the next summer, which kind of makes sense because the lag effect here. So we're already seeing it. It just hasn't affected employment. When it affects employment, that's when the cards will drop. But until then, long and strong, it seems.
Yeah, and I don't think the Fed governors have been tight-lipped about this. I remember I heard Neil Kashkari, the Chicago Fed head,
Minnesota.
Yeah, or Minnesota. He talked about this 6 months ago. He was like, hey, it's going to be higher for longer. And until we see unemployment start to come down, we have to keep vigilant with this. We have to keep these rates higher for longer. So I think the reality comes, a little bit of the craziness out there, regardless of where interest rates are today, at least some of the craziness might calm the bond market down a little bit, because that, like I told you before we got on, I had a client come over from another firm where they had been holding a portfolio of bonds, and a portfolio of bonds, largely a conservative portfolio coming in. And the thing was literally down 29%, some of the positions down 29%. That's insane. This has not been a place you could go and hide and say, I'll just buy bonds or whatever. You've literally had to have cash over the last year, unless you were in the stock market.
And it's amazing that he was down that much, because the market was down 22% last year. The bond market did have a recovery this year, but then again, with yields spiking in the last 4 months, it could be there. But the fact that they didn't make any changes, other than set it and forget it, it'll come back, is ridiculous.
Yeah, not so much. But like I said, I think it's been an intriguing couple of years. And if you weren't in those 7 or 8 stocks that were really running the show, if you look through a little bit to that, the S&P, we've had this big pop up, but once again, it's been those 8 to 10 stocks that have really driven everything, and they're driving it again. You've seen Facebook and Alphabet and all those up. Apple, but if you were to look at the equally weighted index, it's down for the year.
Yeah. Again, we're about flat on the day today.
Yeah.
But you're right. I think it's going to be employment, and it's going to be those top stocks that's going to be your canary. But right now, it's long and strong, it seems. Got to get past that 50-day, and we'll see what happens here. I think things may moderate to wait and see between the government potential shutdown next month and what happens in the Middle East. And if either one of those truly get worse, for lack of a better way of saying it, I think we'll get our factor here where the market's going to go by the end of the year. Next year, who the hell knows? But
and it's going to be crazy next year, because we're going into probably a pretty contentious presidential cycle.
What do you mean pretty contentious? It already is contentious.
That's true, but it gets worse. It hadn't got worse yet. It's going to get way worse as we roll into next year. I would say a lot of opportunities for up and down and craziness, and I may need my emotional support alligator before it's all over with.
I'm going to go for the peacock because somebody tried to bring that on a plane about a year ago. I think that might be more interesting, quite frankly. At least it'll be more colorful if it gets angry.
I'm thinking so. I'm just thinking that I've already got somebody sticking their feet through the seat and things like that. I can't imagine you getting hit by peacock feathers while on the plane. So.
It's insane. I hear you. We'll have to see how things pan out over the next week.
Awesome. Folks, thank you for being on. We do these shows for you, as always. So make sure that you subscribe to the channel and make sure that give us a little thumbs up there. We've been getting more and more of those lately as I've been asking for them. So make sure you give us a little thumbs up to let you know we're out there. And that also helps us in the rankings so that we can get to more folks. So thank you for watching, and we will see you back here the very next time.